Welcome to another weekly video market commentary, and I'm here with Alisha Norris today, our senior portfolio manager. And one of the things we want to talk about again is the notion of a recession. Whether we may be in one right now or may not be, the reality is that term has been thrown around a lot, and it's certainly a topic we have covered 3 or 4 times over the past month and a half. Most importantly, what we want to touch on is just capital market expectations, right? Equity market returns, bond market returns during this tumultuous period, because those are things that impact investors immediately in the immediate term, rather than maybe an elongated economic cycle. And if you recall, a couple of weeks ago, and we'll share a link to this, we released our research paper that pretty much indicated equity markets in general tend to trough, means bottoming out, in that 3 to 4 month time frame before the official announced start of a recession, right? And one of the things that we always hammer on is the official announced start of a recession is a lagging indicator of the previous 6 months. And that's very hard to actually grasp as an investor, because what that entails is putting money in the market at what may be perceived as a bad time. The reality is it couldn't be a better time, or in that notion, selling bonds and buying stocks. So we took that research actually a step further and extrapolated some analysis that Alisha is going to share with us on the notion of that lagging indicator of an official start of a recession and what that means for stock market returns relative to what we've experienced so far year to date. So Alisha, walk us a little bit through our piece here titled Peak to Trough S&P 500 Declines During Recessions.
Sure. So we looked at 2 different data sets. We looked at all recessions from post-World War II. So going back to 1948 and then through 2020. And what we found was that from the market peak to the official start of a recession, the S&P 500 has declined a median of 7% during that time frame. And when we extend that out further and we do the peak to the trough during that recession, the median decline is 24%. So why that's interesting today is because our peak in January of 2020 to our trough in mid-June was a decline of 23%. So we are right on par with that median decline.
That's amazing. And I want to clarify, when she's talking about the start and end, it's actually the not the official announced time frame. It's actually historically the exact point in time when that happened.
Correct.
Which is why we're in a one-to-one kind of par scenario. What could that potentially mean here as we look ahead to a recovery, as we look ahead to better earnings expectations, things like that?
I want to piggyback off what you just said, in that the announcement of the official recession occurs 6 months after the official start date. So one of the things that investors typically think is that we're in a recession if we have 2 consecutive quarters of negative GDP, which is the case currently.
Right.
But in reality, the National Bureau of Economic Research makes that determination, and they look at many different data points, monthly data points and quarterly data points. So by the time they make that announcement, it is an extremely lagging indicator.
Yeah, which is, and we kind of talked about this last time. It's crazy to be in a recession having 520,000 jobs created in the month of July.
Exactly.
At that point, right? So I'm glad you brought that up, because as a result of that, as we price equities into the future, one way stock market is priced is forward earnings expectations. And one of the things we did additionally here on the team on the research side, which we're going to release this second research paper, is simply tracking the forward price to earnings ratio of the S&P 500 with subsequent 1-year returns, right? So if the market is trading at a 17 multiple on a forward-looking basis, what has that historically meant for 1-year forward-looking returns? And we have found a statistically significant relationship to kind of put us in the track for fairly strong potential returns based on this data set, on that expectation. So based on that data being objective, right, walk us a little through our continued stance on equity market participation relative to bonds or commodities or anything like that.
Sure. So when we ran this analysis, we charted it out, and you will see this when we release this document, but it shows the forward PE ratio is at 19 or below. Typically, we have seen positive equity market returns. And where we are right now, around high 17, we have a good likelihood that we will see positive returns down the road. Now, we don't have a crystal ball. We
Right.
don't know that. I have to put that disclaimer in.
Yeah.
But that supports our view that equity market participation is favorable in this environment.
Yeah, and the vast majority of data points, right, speaking strictly from the historical research, the vast majority do lie in that double-digit return category, which we remain very, very adamant about equity market participation, increasing it, maintaining it, and when possible, taking advantage of all opportunities. So, Alisha, thank you very much.
Thank you.